Welcome to the Year Ahead, a podcast series where we will be exploring the major themes and events shaping 2025. And for today's edition, we'll be focusing on environmental, social, and governance, or ESG thematics. And I'm very pleased to be joined by Shubha Samalia from our Economics and Markets Strategy team, as well as Vishal Saxena from our Climate and ESG Capital Markets team. And as you will see in the year ahead, we've dubbed the ESG chapter the ESG Kaleidoscope, reflecting that we expect a more complicated picture in terms of sustainability and sustainable finance next year, with rather different trends and emphasis between different regions, particularly the Europe and the United States, and indeed also a broader set of areas that we expect the market to focus on. So shifting from purely or more focused on climate change mitigation to also considering adaptation, nature, and other thematics. So I look forward to the discussion now to dive into some of these areas with Shubha and with Vishal. And perhaps, Shubha, starting with yourself, we start the chapter off by calling out the difficulties in sustaining some of these global climate coalitions, such as the various net zero coalitions within the financial industry, or indeed Climate Action 100 plus, where we've seen a bit of moderation or indeed a little bit of a drop in membership numbers. We expect that to continue. There's some difficulties of these global sort of broad churches. And why do we think that is, Shubha? I welcome your perspective.
Yeah, so thank you for the question and a warm welcome for all our listeners all over. So yes, we do expect Sustainability Coalition to be struggling a bit next year, and that is primarily because of two reasons. One, there is a broader disagreement in general around the pace of this decarbonization. So countries and organizations that are more fossil fuel reliant, or in general where political environment is more climate skeptic, we expect these organizations to sort of have some pushback or some laid back initiatives around decarbonization in general, like they could push towards less eminent initiatives around decarbonization slime or delayed the timelines towards transition in general as compared to more climate concerned organizations. So to keep these two groups together, one which sort of want to delay the timelines a bit and one which is more climate concerned, we think is going to be a challenge next year. Apart from this, there are also disagreements around the role that private institutions are supposed to be playing here. Financial institutions in particular, like they're more prone and more open to the political and the societal debate around both the nature of integration of ESG initiatives into investment strategies and to the extent that ESG factors should be integrated and be playing a role there. Like if we talk about investors in general, there is a base that sort of thinks this is not linked to fiduciary duties or it's sort of even a breach of that. While there are others who sort of think that this is a more holistic way of developing an investment strategy. So because of both these disagreements on these grounds, the pace of decarbonization, trajectory of decarbonization, and the disagreements around the role that the financial institutions are supposed to play, we do think this would weigh down on sustainability coalitions next year. Like they would find it difficult to maintain a broader supporter base while also setting up ambitious targets for their members.
Thank you, Shubha. And of course, another complication for these overarching and global coalitions is that some of the major economic forces may be moving in slightly different directions next year. And would love to get your perspective on the United States with the Trump presidency. How could they pursue or perhaps not pursue certain sustainability policies, and then of course the European Union. What do you think will be the key areas to look out for there next year?
100%. These are the two most important regions to keep an eye out for to define the climate agenda globally. So I'll sort of start with EU in general. We think the political case for climate action in EU would shift a bit, like it would shift towards economic growth, shift towards competitiveness. It would shift towards development of energy security. The European Green Deal would still be there. It would be the basis of it. But still, this shift would sort of play out in general. So if we talk about the broad levers that would play out in EU next year, I would say I would say sort of more alignment between the member states in terms of decarbonization policies, then more public-private coalitions and initiatives so that access to green finance is sort of improved, and then improvement in permitting processes so that investments, clean energy investments in general, are fast-tracked. And there is clearly a case for EU to act on this. Like it's already a global leader in climate technology investments, could have an impact on um, climate technology innovation globally in general. 2025 is also going to be a litmus test in general for some of the EU sustainability disclosure initiatives. We are going to see first sustainability reports that are going to come out of CSRD initiative. And this could set a benchmark globally for transition plan disclosures elsewhere. We talk of US, the dynamics is going to be a little different. I think President Trump, Republican Party, they both have been sort of pretty vocal about their climate agenda on the campaign trail. So it has broadly been around three lines: increase in fossil fuel production, then sort of discouragement for the integration of ESG factor into investment strategies, and also sort of around taking away or shifting the incentives that are there for clean energy investments in the Inflation Reduction. So at the back of these three things, we definitely we think that the fossil fuel production could increase at the domestic level in US next year. This could also be accompanied by the withdrawal from the Paris Agreement, which could again could have a negative impact on the climate agenda globally. In terms of the shifting of the subsidies for climate clean energy investments that are there in Inflation Reduction Act, we somehow think that the political case for that is lacking. And that is because most of the investments and most of the benefits in terms of both clean energy investments and job creation, because of these subsidies in the Reduction Act, have gone to the red state. So the political case for complete repealing is missing, we think. So, and in terms of integration of ESG factors, we definitely see more restrictive regulations from the federal bodies. But then again, those could be challenged by the blue states, the larger ones, some like New York or California, who have already come up with a legislation around disclosure implementation, disclosure initiatives, and all those things. So yes, more restrictive regulations from the federal bodies.
In my mind, there's an interesting parallel here between Europe and the US, as you describe it, that the reality also of economic priorities, which of course feed into the political agenda. As you said, in the US, the IRA has generated significant job creation, particularly in sort of Republican party-led states. And then in the European Union, there's this wider agenda to improve economic competitiveness, and then using particularly green industries to support that. So I think that economic element is interesting to see how that links in to ESG. And nonetheless, as you've described it, there's quite different pathways here potentially. And perhaps Vishal, turning to yourself, for international organizations, investors, companies, how do we think they can best navigate these different pathways being followed?
Thank you, Arthur. Hi everyone. It's a pleasure to be here today. And absolutely, it's fascinating to think about some of these dynamics and kind of the interplay and what's ahead, really. But when we really think about the implications for issuer sustainability strategies going forwards, it's whilst the dynamics will continue to evolve over time, and this kind of broader macro and political environment, ultimately, we see a really kind of clear need for organizations to, really consider how to evolve their businesses over time to better address, ultimately this ever-growing risk from the physical issues that we are seeing, across the world. And, this is certainly resonating with our conversations with a number of stakeholders and investors as well. So the need to decarbonize and deepen ESG impact at this kind of accelerated pace, definitely does remain. And there are, I would say, a few key levers that are top of mind that we've, identified that issuers can really hone in on, based on some of the recent investor surveys we've undertaken. So I'll highlight a few of these, briefly, but notably, again, building on some of Shubha's points from earlier, really thinking about how can an issuer, embed strategic transition planning more meaningfully into its planning and strategy. That's kind of first and foremost, and there's an increased focus on that globally with more transition plans coming into the market, in kind of recent months. Again, building on the prior point on physical risk, that's a major area of focus, and so enhancing and conducting risk assessments within the company and broader supply chains is again something that is in focus and something that companies should really look to double down on in the coming months and years. So the third point I'd like to mention is not just on quantitative disclosures, but also on qualitative. And this can really help with building engagement with investors and wider stakeholders on climate and ESG decision making. Having a clear articulated strategy in place that brings a lot of those things together in one kind of neat umbrella. It really helps to evidence what the interventions are, what are the focus areas, in the coming months, be that across various kind of climate initiatives, but also on the social front, and more also in terms of how, from a governance perspective, how a senior leadership really, taking this on and executing on some of those plans.
Thank you, Vishal. And it reminds me of comments we get from various market participants around, well, there's a political pendulum, right? And then it moves around this topic back and forth as it does on other political topics, but there is a broader trend line, there's a broader ratcheting up of expectations around the course that international organizations, FIs, corporates, SSAs, etc., need to take. And to your point, then that is all about embedding in the strategy and disclosure in the target setting. So I think that's really helpful. And let me pick up on one of the areas that you spoke about, which is climate change, adaptation, and physical risk. And it's an area that we've called out as well in our chapter. And I'd like to ask you why we've called that out. Why do we think that's going to be of increasing relevance in 2025?
Absolutely. Thanks, Arthur. Yeah, I think ultimately, unfortunately, we're facing into a reality where, the impact from ongoing extreme weather events is going to be continued to be felt globally and, collectively across economies. The data suggests that we're likely to overshoot our, 1.5 degree target threshold. So it's, that's definitely, an area of concern, I would say. And that's really creating this kind of urgent call to action. And 2024 has been yet another case in point. Again, a record-breaking number of natural catastrophes where we've seen at least $1 billion of economic losses. It just goes to show the scale and the size of the challenge that we're facing into. And so when we're really talking about this urgency on adaptation financing, it is really due to these factors: the increase in extreme weather-related incidents that is creating new CapEx requirements and investment opportunities for projects that will ultimately enable communities to withstand and be more resilient in the face of these incidents. Flood defenses are a prime example, and the recent flooding in Valencia really puts this into perspective. The flood losses here are likely to be the country's worst insurance hit from natural catastrophe in modern history. And, when we think about it, for example, from the UK's positioning as well, some recent research from Bloomberg and the UK Environment Agency noted only high confidence for only 15% of flood defense projects that will actually be delivered on time. So there's a real kind of gap in some of these enablers coming in, and that's where we see an opportunity as well, And so we certainly see enhanced momentum on adaptation as a theme in 2025. Which will, result in particular opportunities for infrastructure and project finance.
Thank you, Vishal. And actually, building on that, as you say, there's a real investment need, a real investment potential around adaptation, as there is, as we've described also, in terms of climate change mitigation and indeed the other sustainability themes. Yet if you look at the sustainable finance, labeled debt market. It sort of peaked in 2021, right? A lot of COVID-related issuance, and then it kind of started moving more in alignment with the overall debt markets and perhaps shrank a little bit in recent years. Looking into 2025, I mean, what do we expect in terms of supply volumes?
Absolutely. Thanks, Arthur. So, I think this, in spite of this kind of slightly fragmented ESG landscape, we anticipate continued growth of the sustainable finance debt markets. When we're considering issuance on green, social, sustainability and sustainability linked bonds, and we're looking at around $1 trillion equivalent, up from around up 7% in comparison to what we expect for 2024. And this is somewhat perhaps higher than growth expectation for the global debt markets, which perhaps reflects a bit of partial decoupling. But as in previous years, we expect green to remain the dominant format across these labels, accounting for about 60% of supply. And this label will be boosted by investments in notable green subcategories, such as you say, climate change adaptation, but also biodiversity. And blue debt is something that we're seeing an increasing focus on, kind of in recent months as well. Next year, we also expect to see the emergence of dark green EU green bonds, accounting for an expected 5 to 10% of global green bond supply. And our client conversations suggest, many large green finance issuers are taking a wait and see approach towards this, given the progress on the EU green bond standards. On the sustainability linked debt side, again, we likely see this to grow by around 20% from 2024 levels. However, this will make up a smaller chunk of the market at around 4% of overall sustainable finance supply. In terms of kind of new innovations, we do see, additional FI issuances in the sustainability linked loan financing bonds format. Again, this has been something that's been coming through, in the past kind of year or so, and the types of KPIs that should also start to move beyond carbon now that the first cohort of firms have set science-based nature targets. So there's a few themes in there, but definitely momentum to be continuing across these labels.
That's great. And the point you make, I think, is really relevant, that from a bird's eye view, okay, well, green is still 60% and similar sort of makeup of the other labels. But actually, when we dive into the components, like you say, more adaptation financing, this introduction of EU green bonds, it will become, I think, a more diverse asset class next year. So I think that's exciting. We spoke about the major thematics that we've called out in our chapter, but before we wrap up the podcast, I'd like to ask both Shubha and Vishal if there's another area of ESG, of sustainability, that they think has probably been underappreciated, which they hope will get more in focus next year. So Shubha, over to you.
Talk about how the climate-induced weather events have been increasing, both in terms of number, frequency, and severity as well. I do think that these physical risks which are coming with these climate events, they have an implication for monetary policy. And there are increased talks around those all over globally for that matter. So what do central banks sort of do to incorporate these physical risks in terms of their decision making and how it impacts them? That would be very interesting to see. And also it deserves more attention. Like, again, there is a huge divergence globally in terms of how central banks are acting with respect to incorporating these risks. More or less, like, again, how the governments at their end in their jurisdictions are behaving, the central banks are taking the same direction. Apart from that, I do think, like, we all know that how important regulations are for corporate sustainability disclosures in general, both in terms of risk management, also in terms of flow of investments in the right direction. I would definitely be having my eyes open with respect to the first sustainability reports that are now coming out of CSRD directive to see if there is an expansive influence of this for non-EU businesses as well.
I would fully echo that. I think CSRD is a material step forward in terms of sustainability disclosure. So seeing the first wave of those reports, I think, will be very, very interesting.
Absolutely. I think one thing that, we're certainly very focused on is thinking about, what is the role for insurance as a sector in supporting transition, over time, and also a number of other sectors in their journey to decarbonize. And, when we think about, the challenges around physical risks and the escalation of these that we've mentioned, there is, a still wide insurance protection gap. It's something that we've spotlighted in the year ahead. This remains at kind of around 60 to 70%. And so players in the insurance sector are really having to consider how to better adjust some of their business models to be in a more robust position, I would say, to calibrate and understand these future risks. And so we're, examining some of these themes quite closely and thinking about where is there disruption likely to be seen, across the insurance value chain? Where are there opportunities for innovation as a result? And ultimately, what are the different levers that the insurance sector can kind of utilize to help, its wider stakeholder groups become more resilient in the face of these physical risks? And so I would say, this is kind of a very important theme going ahead. It was certainly a focus at COP29 as well. And so the role of insurance, will be integral to supporting the transition and a lot of innovations over time and helping to really de-risk that agenda. I think that's where we'll start to think about more of these solutions.
Yeah, I think really, really valid point. And that, as you say, climate change, adaptation, dealing with, as you've well described, there's sadly this growing number of physical risk events, I think presents quite a profound shift in thinking in sort of developing products coverage for the insurance industry. So fully agreed, and also very much that it's been perhaps under appreciated thus far. So as you say, it's important that world leaders in COP29 have been starting to delve more into this challenge. Thank you, Shubha. Thank you, Vishal, very much for sharing your insights. Thank you to yourself for listening. If you like what you've heard, please make sure to subscribe to our channel and indeed also press the like button. And if you'd like to read more of the NatWest insights on the year ahead, please navigate to natwest.com/year ahead to read more of these insights, both on ESG and indeed other economic and market strategy topics. Thank you.